On Thursday, February 12th, 2026, a military-grade psychological operation was executed in broad daylight against the silver market. And the question this file answers is not what happened. The question is who had their finger on the trigger, and whether your capital was the intended target. Most people watching this believe that price movements in commodities are organic. Supply shifts, demand adjusts, the market finds equilibrium. That is the approved curriculum. You see, the approved curriculum is the cage. What actually happened on February 12th was not a market movement, it was a narrative spoof. A synthetic news event, precision-timed, algorithmically detonated, designed to protect hundreds of millions of dollars in bank short positions, while retail investors, people exactly like you, absorb the blast. This file uncovers the fabricated headline and the central bank denial that the financial press buried the vault drain running silently underneath the paper price crash, and the historical deadline that makes September 3rd, 2026 the most mathematically significant date in the silver market in 50 years. This is not financial advice. I am not a licensed advisor. Your capital is your responsibility. Always conduct your own research. Now, let's open the crime scene. At approximately 9:47 a.m. Eastern on February 12th, 2026, two of the most algorithmically influential financial terminals on the planet published the same headline within minutes of each other. Bloomberg, Reuters. The headline read, "Russia considering return to US dollar." In a market dominated by NLP, natural language processing, trading algorithms that scan headlines in milliseconds and execute sell programs before a human analyst can read the subheading, that headline was a loaded weapon. The algorithms registered it, flagged it, classified it as a dollar bullish, commodity bearish macro signal, which means the sell programs fired instantly. Silver was trading at $85 per ounce at 9:46 a.m. By 9:49 a.m., it had been smashed to $74, $11, erased, in under 3 minutes. Now here is where the data diverges from the narrative. Elvira Nabiullina is not a minor official. She is the governor of the Russian Central Bank, the single most authoritative voice on Russian monetary policy on the planet. And her office issued a formal statement that the financial press did not place on the front page. The Bank of Russia's position, in her words, was precise. The Bank of Russia is not currently taking part in talks on the possibility for the return to US dollars. Not ambiguous, not a soft denial. A categorical institutional statement, which means the headline that just vaporized $11 from the silver price was functionally false at the moment of publication. Stop. Let that sequence run again in your mind. A headline appears. The central bank governor formally contradicts it within hours. The price has already been destroyed. The retail investor has already panic sold. The correction when it came was quiet. The damage was permanent for anyone who did not hold through the engineered floor. You see, this is the mechanism. It is not new. The technical term inside trading desks is sentiment spoofing. Most people understand order spoofing, placing fake buy or sell orders to manipulate price. But in 2026, the banks no longer need to spoof the order book. They spoof the news cycle. They feed a narrative into the highest distribution terminals. The NLP algorithms do the rest. Retail fear accelerates the move, and the short position prints. Now, most people watching this will stop here and conclude they understand what happened. A false headline, a manipulated drop, a cover-up, and they would be partially correct. But here is the second layer that changes the entire equation. While the paper price was being engineered downward by $11 in 3 minutes, something was happening in the physical vaults that the Bloomberg headline did not mention, that Reuters did not cover, that no mainstream terminal flagged. The vaults were being drained, not slowly, not incrementally. On February 11th, 2026, the day before the synthetic news event, registered silver on the COMEX fell below a threshold that has not been breached in years, dropping to 98,138,005 ounces. If that number means nothing to you right now, it will. Because the question is not why the paper price crashed. The question is why? At the exact moment the paper price was being demolished in public, the physical metal was quietly leaving the building through the back door. That vault drain, who executed it, and what it mathematically signals for the September 3rd deadline, is the smoking gun in Block 2. If the divergence between the paper price and the physical vault drain just opened a question in your mind that you need answered, you are exactly the type of analyst this channel exists for. Join the Forensic Circle, subscribe. The next file goes deeper. Let's go back to February 11th, 2026, the day before the synthetic headline. Because the sequence did not begin with the Bloomberg terminal. It began 24 hours earlier in a temperature-controlled vault beneath the streets of Lower Manhattan. Most people tracking the silver market on February 12th were watching the paper price, $85, then $74, an $11 collapse in under 3 minutes. That was the performance. What happened in the vault was the operation. To understand what the vault drain means, you need to understand what the COMEX registered inventory number actually represents. COMEX registered silver is not a general stockpile. It is the specific physical metal that has been formally certified, inspected, and made available for delivery against paper futures contracts. Which means it is the physical foundation that gives the entire paper silver market its legal legitimacy. When that number is high, the paper market can sustain its pricing power. When that number drops toward a critical threshold, the gap between what the paper market claims exists and what physically exists becomes a mathematical fault line. On February 11th, 2026, registered silver on the COMEX fell to 98,138,005 ounces. That number breached the 100 million ounce threshold for the first time in years. Now here is where most analysts stop. They note the breach. They flag it as bearish for the paper market, and they move on. But the forensic file does not stop there, because the size of the single-day withdrawal is the smoking gun. Total net withdrawals from COMEX registered and eligible silver combined on February 11th reached 4.7 million ounces in a single trading session. 4.7 million ounces in one day. To put that in context, the average daily withdrawal from COMEX silver vaults over the preceding 12 months was less than 500,000 ounces. Which means February 11th was not a routine transfer. It was a deliberate extraction, an operation executed with surgical precision. The day before, a synthetic headline was fed into the two most algorithmically influential financial terminals on the planet. Now let's go deeper into the vault data, because the aggregate number is significant. But the source of the drain is the confession. Of the 2.8 million ounces withdrawn from COMEX registered silver on February 11th, 2.44 million ounces came from a single vault, the JP Morgan vault. Stop. Let that ratio settle. 2.44 million out of 2.8 million total. That is 87% of the entire registered withdrawal from one institution on one day. The day before a market-moving synthetic headline was published by terminals that institutional traders rely on for algorithmic execution. You see, in forensic analysis, we do not deal in coincidences. We deal in sequences. And the sequence has a very specific shape. The physical metal leaves the JP Morgan vault on February 11th. The synthetic narrative enters the Bloomberg and Reuters terminals on February 12th. The NLP algorithms execute the sell program. The paper price drops $11 in 3 minutes. Retail investors panic sell their positions at $74 per ounce. The institution that just moved 2.44 million ounces of physical silver out of the registered inventory is now sitting on the correct side of both trades. They hold the physical, they triggered the paper crash, and they will buy back the paper contracts at the engineered floor before the correction quietly runs the price back up. That is not speculation. That is the documented mechanism of a sentiment spoof. And it has a second layer that most forensic analysts miss entirely. Here is where the curiosity loop resets. Most people following the February 12th crash reached the same logical conclusion. JP Morgan drained the vault. The synthetic headline crashed the paper price. The short position printed. Classic market manipulation. And they would be correct, but they would be solving for the wrong crime. Because while Western analysts were debating whether the Bloomberg headline was intentional or incompetent, the Shanghai Gold Exchange was publishing a silver benchmark fix that no mainstream terminal chose to lead with. The Shanghai Silver Benchmark on February 12, 2026 was fixing at approximately $10 above Western spot prices. $10. In commodity markets, a divergence of that magnitude between two major pricing benchmarks for the same physical asset is not a rounding error. It is a structural fracture. Here is what that fracture means in forensic terms. The Western paper price, the COMEX spot price that Bloomberg and Reuters publishes the global silver benchmark, is determined primarily by paper contracts. Futures, options, derivatives. The vast majority of these contracts are never settled in physical metal. They are settled in cash, which means the Western paper price reflects the sentiment of the paper market, not the scarcity of the physical market. The Shanghai Benchmark, by contrast, operates with significantly higher physical delivery requirements, which means the Eastern price reflects what buyers who actually want the metal are willing to pay. And on February 12, 2026, those buyers were willing to pay $10 more per ounce than the Western paper market was pricing it. You see, a $10 Eastern premium is not a trading anomaly. It is the physical market overriding the paper market's engineered price signal, which means the paper crash on February 12th did not reflect a loss of confidence in silver. It reflected a loss of the West's ability to suppress the price of a commodity that the East is now pricing independently. The pricing power is already transferred. The Western paper market just has not admitted it yet. Now let's close the loop that was opened in the intro. The question was not what happened on February 12th. The question was whether your capital was the intended target. Here is the forensic answer. The COMEX vault breach on February 11th was not a symptom of declining silver interest. It was a preparatory extraction. Physical metal moved out of registered inventory before the paper price was engineered downward. The JP Morgan drain, representing 87% of that extraction, was not a coincidence of timing. It was the execution fingerprint of an institution that needed to separate its physical position from its paper exposure before the synthetic narrative hit the terminals. And the $10 Shanghai premium was not an Eastern market inefficiency. It was the physical market's real-time verdict on the Western paper price, delivered in the same 47-second window that the paper price was being demolished. The math is now visible. The paper price is not the price. The paper price is the managed perception of the price. The real price is being set in Shanghai. The real inventory is being tracked in vault withdrawal data that Bloomberg does not put on the front page. And the real sequence is running on a timeline that converges on a specific date that the mainstream financial press has not yet assigned the weight it mathematically deserves. September 3rd, 2026. But to understand why that date is not arbitrary, you need the historical archive. You need to see this exact fingerprint on 3 previous empires before the current one. You need to understand the maturity wall, the critical minerals confession, and the government program that is about to enter this market as a price-insensitive buyer with a $900 billion annual budget. That is the file that Block 3 opens. If the vault drain data just confirmed what you suspected but could not prove, you are operating at the right frequency. The Forensic Circle tracks these withdrawal numbers in real time. Subscribe. The sequence is accelerating. Have you ever wondered if we're living through the end of an empire? It sounds dramatic, but history offers some fascinating parallels. Today, we are diving deep into a framework developed by a brilliant financial analyst who studied the rise and fall of great powers, from the Dutch to the British, and even ancient Rome. He identified 7 distinct stages of imperial collapse. Let's see how they stack up against what's happening in the United States right now. Stage 1 is a massive buildup of debt. When a country becomes the world's reserve currency, like the US dollar is today, it gets a superpower. It can print money to pay its bills. This seems great at first, but it often leads to borrowing more and more, creating huge deficits. The US national debt has been skyrocketing for decades, crossing into tens of trillions of dollars. This isn't just a number, it's a sign of a system under immense pressure. This leads us to stage 2, a widening wealth gap. As the central bank prints more money to cover the debt, this new money flows into financial assets like stocks and real estate. Who owns most of these assets? The wealthy. So, while the rich get richer, the average person's wages don't keep up with the rising cost of living. This creates social tension and a feeling that the system is rigged. We see this today with debates about inequality and the struggles of the middle class. Stage 3 is when things get really interesting, the decline of education and infrastructure. When a nation is so focused on paying its debts and funding its military, long-term investments like education, roads, and bridges get neglected. Think about it. We hear stories all the time about crumbling infrastructure and a school system that is falling behind international standards. A nation's true strength lies in its people and its foundation, and when those are ignored, cracks begin to show. Next up, stage 4, the hollowing out of the middle class. This is a direct consequence of the previous stages. As manufacturing jobs move overseas and inflation eats away at savings, the once stable middle class shrinks. More people fall into poverty, while a small elite class pulls further away. A strong middle class is the backbone of a healthy society. When it weakens, the entire structure becomes unstable. Stage 5 is the loss of global competitiveness. For a long time, made in America was the gold standard. But as costs rise and investment in innovation dwindles, other countries start to catch up and even surpass the empire. We're seeing this happen in real time. Nations across Asia and Europe are becoming powerhouses in technology, manufacturing, and trade. The US is no longer the undisputed economic leader in every field. This brings us to stage 6, military overreach. Historically, fading empires often try to project strength through their military. They get involved in costly conflicts around the world, draining resources that could be used at home. This is often called an imperial overstretch. The US has military bases all over the globe and has been involved in prolonged wars for decades. The cost is astronomical, not just in money, but also in human lives and domestic priorities. Finally, we arrive at stage 7, the challenge to the reserve currency. This is the endgame. When other countries see the empire's massive debt and declining economic power, they start to lose faith in its currency. They begin looking for alternatives to trade in. Recently, we've seen major global players like China and Russia actively trying to move away from the US dollar. If the dollar were to lose its status as the world's reserve currency, it would be a seismic shift, making it much harder for the US to finance its debt. So, where does this leave us? Is the United States doomed to follow the same path as Rome or the British Empire? Not necessarily. History is a guide, not a script. The first step to solving a problem is recognizing it. By understanding these 7 stages, we can see the warning signs and start having honest conversations about the difficult choices that need to be made. It's about fiscal responsibility, investing in our people and infrastructure, and reevaluating our role in the world. The future isn't written yet, and awareness is the key to changing course. What do you think? Are these parallels convincing, or is it a different story this time? Let me know your thoughts in the comments below. Thanks for watching, and don't forget to like and subscribe for more deep dives into the forces shaping our world. See you next time. The single largest economy in human history, with a defense budget of approximately $900 billion per year, entering a commodity market where registered physical supply just broke below 100 million ounces, as a buyer with no price ceiling. That is not a bullish signal. That is a mathematical certainty dressed in policy language, and it converges on the same timeline as the maturity wall, the same timeline as the COMEX vault drain, the same timeline as the Shanghai premium divergence, the same timeline as September 3rd, 2026. You see, this is what the forensic archive looks like when you stop reading the headlines and start reading the sequence. The Spanish Empire saw the divergence too late. The British Empire saw it too late. The American investor of 1929 saw it too late. The data does not guarantee you will act on this, but it does guarantee that the sequence will complete. The vault is draining. The government just declared strategic dependency, and a price-insensitive buyer is about to enter the room, which means everything you just absorbed in this block is still only the context. The mechanism that closes this sequence, the one that sets the September 3rd deadline in mathematical stone, is what the final block opens. Let's run the full sequence one final time. A synthetic headline detonated the paper price. The central bank denial was buried, the algorithms executed, and while retail investors absorbed $11 of engineered loss in 3 minutes, 2.44 million ounces of physical silver left the JP Morgan vault through the back door. That is not a conspiracy, that's a documented sequence. And it is running on the same mathematical track as every Imperial Stage 5 collapse in the forensic archive. The paper price is a performance. The vault drain is the confession. Most people will watch this file, feel the weight of it for 48 hours, and then return to the approved curriculum. They will watch the Bloomberg terminal, they will trust the Reuters headline, and when September 3rd, 2026 arrives, they will be genuinely surprised. The math was never hiding. It was just written in a language most people were never taught to read. You now speak that language, which means you have a choice. You can carry this forensic key alone, or you can join the analysts who receive every new file the moment it is opened. If this sequence changed the way you see the machine, subscribe to the Forensic Circle, not because of the content, because of what it costs you not to. The next file opens the September 3rd mechanism in full, the architecture behind China's metal-backed settlement reveal, the exact legal framework that makes the transfer irreversible once it executes. Do not miss it. The verdict of this autopsy is clean. The price is a lie. The vaults are draining. And on September 3rd, 2026, China does not announce a policy shift. They announce a financial fait accompli, a move that was prepared while the West was reading the headline, executed while retail was panic selling at $74, and completed before a single mainstream terminal knew what to call it. They bought. You held. Stack now.